I'm going to walk you through a composite trade finance collusion scenario built from patterns documented by FATF, the Wolfsberg Group, and the ICC Trade Register. 4 banks, 5 shell companies, every compliance check passed, everyone cleared. Here's how schemes like this work and where detection fails. Let me set the stage. 5 companies registered across 3 jurisdictions: Singapore, the UAE, and Hong Kong. 3 of the most common corridors for trade finance in the Asia Pacific region. Each company looked perfectly legitimate on paper. Registered business addresses, named directors with verifiable identities, audited financial statements, active trade registrations. If you pulled up any one of these entities in a KYC screening tool, they'd come back clean. Green lights across the board. But here's what nobody saw. All 5 companies shared the same beneficial ownership. Buried 2 layers deep in offshore holding structures. A single network of individuals controlled every entity, but the ownership was routed through nominee directors and shell intermediaries designed specifically to break the visibility chain. Now, each of these 5 companies approached a different bank. Sometimes 2 companies went to the same bank, but through different relationship managers, different branches, different product lines. The banks had no reason to connect them. Across those 4 banks, this network obtained approximately $45 million in trade financing, letters of credit, invoice discounting facilities, pre-export financing lines. All standard products, all individually underwritten, all approved. $45 million, financed by 4 institutions that had no idea they were funding the same people. And the way they built up to it, that's the part that makes this so hard to catch. They didn't start with fraud, they started with credibility. That's the line that should keep every compliance officer up at night. Because collusion schemes don't begin with the crime, they begin with the trust building. For the first 6 months, every single one of these 5 entities operated legitimate trade finance facilities. Small ones, $500,000 to $1 million each. Real goods were shipped, real invoices were generated, real bills of lading matched real cargo at real ports. Each company built a clean track record with its respective bank independently. Payment history, perfect. Documentation, complete. Trade flows, logical. Everything a compliance team would want to see in a low-risk client. And this is by design. The ICC, International Chamber of Commerce, estimates that trade finance fraud losses globally exceed $5 billion annually through their trade register. But what the ICC's own working groups have noted repeatedly is that the most sophisticated schemes involve extended periods of legitimate activity before the fraudulent phase begins. 6 months of clean transactions. That's not just history, that's armor. Because when you've built 6 months of clean activity, you've earned something far more valuable than money. You've earned the benefit of the doubt. After 6 months, once every entity had an established track record, the scheme pivoted. Facility sizes started increasing. What was $500,000 became $3 million. What was $1 million became $5 million. Gradual enough not to trigger sudden increase alerts. Each step justified by the growing quote-unquote track record and expanding business operations. And this is where the invoices became circular. Company A in Singapore issues an invoice to Company B in the UAE for electronic components, $3.2 million. Company B then invoices Company C in Hong Kong for quote-unquote processed assemblies, $4.1 million. Company C invoices Company D back in Singapore for quote-unquote finished goods, $4.8 million. And the circle continues. The goods either didn't exist at all, or they were real goods being re-invoiced at 3 to 4 times their actual market value. In some cases, the same container of goods was used to support invoices at multiple banks simultaneously. One shipment multiple financing facilities, each bank thinking they had first claim on the collateral. This is what the Wolfsberg Group, the consortium of 13 major banks that develops AML frameworks, calls carousel fraud in trade finance. And they've explicitly flagged it as one of the hardest patterns to detect because each individual transaction, viewed in isolation, looks completely normal. Each bank saw only their piece. Bank 1 saw Company A exporting to Company B, legitimate trade flow, supported by documentation, consistent with the client's business profile. Bank 2 saw Company B exporting to Company C, same story. Nobody saw the circle because nobody was looking for one. Now here's the part that makes this a case study and not just a crime story. Let's walk through each bank's controls because every single one did its job and every single one missed it. Bank 1, KYC. They ran full know your customer checks on each entity. Identity verification, sanction screening, adverse media searches, PEP checks. Everything came back clean. Because each entity viewed individually was clean. The problem is that KYC was performed on individual entities, never cross-referenced across the network. Nobody asked, do any of our trade finance clients share beneficial ownership with counterparties at other institutions? Bank 2, transaction monitoring. Their AML system flagged transactions based on size, velocity, and counterparty risk. Every transaction from the Collusion network fell within normal parameters. The amounts were calibrated to stay inside the expected range for each entity's stated business profile. The monitoring system worked exactly as designed. It just wasn't designed to detect circular flows across unlinked entities. Bank 3, trade document verification. They checked bills of lading, commercial invoices, packing lists, inspection certificates, everything matched because the documents were professionally forged. The Financial Action Task Force, FATF, published guidance in 2021 specifically warning that trade-based money laundering increasingly involves sophisticated document fraud that passes standard verification. We are not talking about obvious forgeries. These were pixel-perfect reproductions with matching reference numbers, proper formatting, and consistent data. Bank 4, annual review. They reviewed the client's financial statements at the 12-month mark. Revenue figures looked healthy. Profit margins were consistent with the industry. Working capital ratios were in line. Of course they were, because the circular scheme generated matching revenues. Company A's exports to Company B showed up as revenue for A and cost of goods for B. The financials were internally consistent because the fraud was internally consistent. Every control worked perfectly in isolation. None of them talked to each other. 4 banks, 4 compliance teams, 4 sets of controls, 4 green lights, and $45 million financed into a single collusion network that nobody could see because nobody was looking across the. So what would have actually caught this? Not better versions of the same controls, different controls entirely. First, cross-entity beneficial ownership mapping. If any single system had mapped the ultimate beneficial owners of all 5 entities and found convergence, the network would have been visible before a single dollar was dispersed. The Basel Committee on Banking Supervision has been pushing for enhanced beneficial ownership transparency since 2019. Most mid-market institutions still screen entity by entity. Second, graph analysis showing circular transaction patterns. If you map every trade finance transaction as a node and edge graph, entities as nodes, invoices as edges, the circular pattern lights up immediately. You don't need AI for this, you need network visualization. But most trade finance compliance systems operate on flat tabular transaction data. They see rows, they don't see shapes. Third, anomaly detection on invoice pricing versus market rates. When electronic components are invoiced at 4 times the prevailing market price for that commodity class, that's a detectable signal. Commodity price benchmarking against trade invoices is something the Bankers Association for Finance and Trade (BAFT) has recommended in their due diligence guidelines. Most banks don't do it systematically. Fourth, multi-bank information sharing. Emerging frameworks like the Monetary Authority of Singapore's Cosmic Platform, Chale launched in 2024, are specifically designed to allow financial institutions to share red flags about trade finance clients across institutional boundaries. The UK's Joint Money Laundering Intelligence Task Force has operated a similar model. But these frameworks are still early stage and most mid-market banks aren't participants yet. You don't need better individual controls, you need connected intelligence. The ability to see entities as networks, not rows. To see transactions as patterns, not line items. To connect what Bank 1 knows with what Bank 3 sees. That's the difference between a compliance checklist and actual detection. I'm building Flux Force because every control in this scenario worked and the scheme was invisible. That's an architecture problem. Aiden Flux handles fraud detection today. Graph-based entity intelligence, ownership mapping, circular pattern detection is on the product roadmap. If you work in trade finance compliance and you've seen a version of this pattern, I want to hear about it. What broke first? What signal did your team eventually find? Those answers matter more to what I'm building than any model architecture. Link in the description. I'll see you in the next one.